So much can change in a single day. Nvidia went from green in the after hours to red in today's trade, and sentiment looking like some bearish capitulation. And with tariffs reaffirmed for March 4th and an additional 10% on China, things are going from bad to worse at light speed. Markets are hanging on by a thread, and one more red day can see stocks officially in correction territory. So will we keep selling? The answer lies in tomorrow's inflation data. If you're a bull, you'll want a cool print, and if you're a bear, you want a hot print. So what are we actually going to report? That's what we're here to talk about, along with Nvidia's earnings, seasonality, and valuation. We're going to dissect everything to give you a comprehensive overview of where we stand and where we're going. So we've got a lot to talk about, but before we roll the tape, please check out my newest channel where I will be breaking down individual stocks in depth. It's FinFluential Media. Nvidia's analysis is live. I'll also be covering Dell's earnings in a couple of hours. It's critical that you guys subscribe to help small channels grow. So please subscribe and let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks plummeted on Thursday as tech sold off following Nvidia's latest earnings report, while investors took stock of the economy amid President Trump's latest tariff pledges. Now, Nvidia was down 7% here today, guys. Pretty ugly, pretty brutal, and that was coming off the highs we saw in the pre-market where the stock was actually up like 2%. So after the earnings call, the market didn't like this, got sold off in the earnings call, and now it's down 7% on the day. We'll talk about Nvidia a little later on in the video. As a result of Nvidia falling, we actually saw all of semiconductors fall as well. On the back of then, we also saw software application and software as a whole. Semiconductor equipment manufacturers and computer hardware fell as well. These are all semiconductor adjacent names. Infrastructure was down, again, led by Microsoft and Oracle. And then we also saw Apple was down nearly 1% as well. Amazon slipped, Tesla continuing its slide. I think this might be the 5th or 6th day in a row where it's down. And then we also saw Google and Meta down about 2% as well, leading the communication service sector lower, with Netflix falling just shy of 3% as well. And it was really these names right here, the Magnificent Seven names, these tech names, these software names that led the selling. But the rest of the market was actually all right. Financials was pretty good. So too was healthcare. Insurance was very green on the back of financials doing pretty good. Energy was kind of green. Real estate showing some outperformance. It was a pretty green day in the broad market. It was really just these tech names, the big Magnificent Seven names that led us lower. And that's why we saw the market price action we did, with the S&P 500 falling 1.6%. Pretty ugly day. Only 3 sectors were green, but this wasn't the full story of the market. Underneath the hood, in every single one of these red sectors, there was definitely some outperformance, relatively speaking. Now, we did see outperformance or green in financials, real estate, energy, and then staples. You can actually see staples here was down. So that defensive rotation didn't really hold up today. So today, to me, was just the market repricing almost everything with regards to Nvidia's earnings and what comes next. You could say there was sort of a value rotation. These are value-led sectors, relatively speaking, to stuff like tech. But we did see tech, AI, and AI-adjacent sectors down 2%. Technology was down 3%, and XLY discretionary was down 1.4%. Gold also fell, and that's because we saw yields move in a very big way. We're going to talk about why. And all in all, it was just an ugly day. But the majority of sectors were actually positive in the market here up until about midday. And that had to do with some announcements we got from the White House. But when we break it down into the factor and size segment, what got hit the hardest was definitely large cap growth, but growth as a whole took it on the chin. Small, medium, and large. Large cap value was the only positive sector here, and that includes, stuff like REITs, staples, financials, they're all in this segment right here. Now they were green, but we didn't see the same type of trade in mid caps nor small caps. So you could say there was, again, a value rotation to the large size value component of the market. This is probably the safest value component of the stock market. Like if there really is going to be a place where large cap funds can put their money, it's going to be the large cap value sector of the market. Core or blend didn't do that well either. Pretty ugly day across the board. Definitely not a day you want to be holding equities, but we have to sit through the volatility as investors. This is simply the price we have to pay for the outstanding returns we've had over the last couple of years. But let's actually talk about why we were red. One of the big reasons actually was economic data. Now, the economic data wasn't bad. It wasn't good. It was neither hot nor cold. It was very mixed, but we did miss on initial jobless claims in a very, very big way. 242 was what we printed. We were looking at 221,000. So maybe some of those Doge cuts and some of those federal employee cuts coming to fruition, rearing its head in the data. The GDP data right here, the growth rate came in at 2.3%. That was the consensus. However, the price index came in at 2.4% versus 2.2% consensus. So a bit of inflationary pressures right there. And I think this was ultimately the big reason why we saw yields move up, along with some of the stuff that came out of the White House. Durable goods actually beat expectations. Very interesting. 3.1% versus 2% consensus. However, we missed when you exclude transport, seeing 0 month over month, seeing no growth month over month versus the consensus of 0.3. So, some data points were good, some data points were bad, but pending home sales, continues to be a bit of a dumpster fire year. You were looking at a year-over-year number forecasted 6%. We got negative 5.2%, a month over month number of negative 1.3%. We got negative 4.6%. So we had good data. We had bad data. We had a ton of Fed speakers as well. What also really moved the market today was Trump. He came out and said that the tariffs on Mexico and Canada will take effect March. That is 20 to 25% on a range of goods, everything from commodities to autos, everything in between. And then he's also slapping an additional 10% tariff on China. So China only had 10% tariffs initially. He's now going to add another 10% to bring it in line into what Mexico and Canada will be facing, which is that 20 to 25% tariff range. And I believe it's only 10% on steel. So the market didn't really like this. Market doesn't really like anything to do with tariffs because the market sees it as inflationary. As a result, globally, things were a bit rough. North America from Canada to the US was not good. South America, very, very red. Europe was very red as well. Asia as a whole, China, Southeast Asia, India, the entire global market was red. So any risk assets you own today just didn't do well. Now, what also moved the market was Nvidia. Now, we really need to talk about this because I came out and said Nvidia's earnings were looking pretty good, and that's because they were up 2% in the pre-market. Turns out Wall Street actually didn't like these earnings at all. Now, I don't think Nvidia should have been down this much. I think Nvidia is mostly down because of the jitters we are seeing in the market. But look, this company beat on top line, beat on bottom line, guided much better than expected. The only problem here was gross margins, which management flagged quarters coming into the Blackwell ramp saying, hey, this Blackwell ramp is going to pressure margins by a little bit. But they came out and said in the middle of this year, we should see margins go back to 75%, or they called it mid-70s range. That's about 74 to 76% range. And I think maybe what the market is extrapolating is that price pressures are there. But I looked over the earnings call significantly and I just couldn't find any evidence of that. So I do think this is probably an opportunity to get in if you want to be a shareholder of Nvidia. I think the stock is probably going to churn between maybe 115 and 130 over the next month or so. So, maybe dollar cost average into this name. I do think we're going to see 150 and above, especially in the back half of the year. Once Blackwell is fully ramped, those margins expand and we get $50 billion in quarterly revenue. Plus, for Nvidia, the stock is an easy buy, anything below $120. And again, you just look at it, you put $5 in earnings power for this stock. This year, by the way, and you apply a 30 multiple, right, you get 150. If you take $6.50 in earnings power for next year, 2026, and apply a 20 multiple, which is below the S&P 500 multiple right now, you get $130. So on next year's earnings, this could be fair value relative to the market multiple of 20. The stock trades at $120 right now. I think anything below 120 is an absolute steal for Nvidia. And if you think you missed the boat, I think this is a great place to go, especially as we continue to see Rubin and Blackwell Ultra ramp up in 2026, 2027. I still think there's another growth year ahead for Nvidia, and I think 120 is a steal. Now, we did see AI adjacent plays get hammered as well. Vistra Energy down 11% today. Now, these guys missed on the top line, but they beat on the bottom line. They grew their business over 100% year over year, and the company said it expects full year 2025 net income of 2.7 billion, right? And the analysts were expecting 2.2 billion. So missed on top line, beat on bottom line, a huge raise. Margins actually expanded. They just missed revenue estimates because of some pricing dynamics in the industry. Again, the street not really liking that, but I still think that this is a relatively attractive name considering the growth you're going to get out of this name over the next 4 years. Now, Dell Technology, another AI adjacent play. They make server racks down 6%, but they reported their earnings after the bell. They were up 3% as of making this video. Now, Dell reported $23.9 billion in revenue. Now, they missed those estimates by $640 million. So they missed the top line. However, they beat on EPS by a pretty wide margin. They said their AI server backlog was looking like $9 billion as of right now. They also increased their dividend by 18%, announced a $10 billion stock buyback. This is probably why we saw a huge uptick in the price regardless of the top line miss. And they also guided a little bit softer than the street expected. However, it was really nice to see some upside in margins, especially in their AI server names, despite the ugly top line miss. Look, the Q1 guide is not pretty, but the backlog visibility probably lends reasonable credence to make up that shortfall in the full year outlook. So that's why the stock was up, I think, 4% here, regardless of the slightly weaker guide, which I think management is sandboxing. Everything we saw, breadth continued to deteriorate. We saw 1,900 advances, 4,300 decliners. We saw inflows in the New York Stock Exchange ever so slightly, but clear outflows in the NASDAQ 100, and this led the S&P 500 to be down 1.5%. And market momentum continues to be on the side of the bears, with shorter term, medium term, and longer term averages looking a little sick. Now, looking at the market, guys, we saw a very red day across the equity spectrum. Large caps, mid caps, small caps were all down, with the worst performing index being the NASDAQ 100 down 2.75%. We are seeing a little bit of green here in the after hours, but we did see value outperform growth handily, but value still in the red respectively. Now, a couple of market dynamics we are seeing. Now, the 2-year yield was down 0.52%. That actually had to do with some of the near-term bad economic data prints we got today. However, the 10-year and 30-year yield was actually higher, and that has to do with the tariff situation. We also saw the dollar up 0.79%. So that all goes to show the market dynamics we're seeing with regards to tariffs. So shorter term yields were down on the better than expected economic data, but the tariffs and missed data, we actually saw longer term yields rise as a result. Bonds fell in aggregate, and we actually did see gold. I actually pulled back today. It says up 0.1%, but that's because we just opened a new session. Gold was actually down 1.36%. And I'm still waiting for gold to pull back here to the 2,700 area, where I will be a pretty big dip buy. I think this is a great place with regards to what the Treasury is going to do with all of the gold reserves and revaluation of gold, something I have spoken about quite significantly. Now, let's actually go ahead and talk about Nvidia, down 8% here today. We continue to trade in this very wide range. You can see for the past 8 months, Nvidia has done absolutely nothing. We've just traded up and down, very, very volatile. I mean, peak to trough, you're looking at declines anywhere from 30% and rallies of like 70% plus. Nonetheless, we are still trading flat in this range for the better part of 8 months, and the market just digesting, the big move we've had in the last 2 to 3 years in Nvidia, 300, 400% moves driven by mostly earnings. And that is why we're seeing, this price action we're seeing right here in Nvidia. Now, again, I'm going to reiterate, I don't think the stock should be down 8%. And part of the thesis yesterday was that because Nvidia was positive, that should lend really well to the markets. That thesis has changed, and our expectations now have to change simply because Nvidia was down 8%. The street telling you we didn't like these earnings. It's upbeat here in the after hours. You can see up 0.76%, but the street just a bit concerned about margins and how that's going to relate to the Blackwell rant. Nonetheless, I think Nvidia is pretty cheap here, and I think if you are looking to enter a great name that is going to grow pretty well over the next 5 years, 5-year revenue growth estimates is still for about 25 to 30% year over year. So you're still looking at a strong grower, a great company with a wide moat. And I think this is a great place to get in. Anything below 120 is just steal. Now let's talk about the S&P 500 and expectations for tomorrow. Now it's very, very simple. Tomorrow is all going to be dependent on the PCE data. If we get a hot print, this is going to slice right through the gamma flip and we're going to go down, maybe even finding support here at the 5760 level. The put support will move down as well. And that's actually what we saw today. The gamma flip, the core resistance, and the put support all actually moved lower today. We previously were at the 5880 level. We're now at the 5860 level, as you can see right here, the put support. So we did move down. We're at the level here. I am a buyer. I did add to some of my ETFs. I'm dollar cost averaging, I added a little bit. If we go lower, I will continue to add. I also bought some EVVTY Evolution AB, the ADR. I think this is a great place to buy, especially if we get an inline or cool print. If we get an inline print tomorrow, I think we're going to find support here in the S&P 500. We could see a little bit of momentum lower because that is the momentum trade we have seen, because that is the trade we have seen today. But if we actually get a cool print, I think we actually go higher. I think a cool print is also going to benefit the RTY, which is also here at the put support. A cool print is really going to support stocks. An inline print could also support stocks. A hot print, we're probably going to see a continuation of what we saw today. The Nasdaq 100 is extremely close to a full correction, down 7.6%. If we get another 2.75% day or just 2% outright day, we're going to be in a 10% correction for the Nasdaq 100. So from all-time highs in just 1, 2, 3, 4, 5, 6, 7 sessions, just a single week or week and a half in trading days, we actually saw stocks, the Nasdaq 100, come to this very, very critical level. So we're going to be dependent on the PCE print, but we get a cool or inline print, I think we find support here and move up. If not, I think 20,000 is our next stop for the Nasdaq 100 tomorrow. Longer term though, I am bullish. Look at the S&P 500. My target is still 6,600 to year end. That hasn't changed, and I still think this is an exceptional opportunity considering the risk to reward to the upside and downside. But I'm particularly finding the Nasdaq 100 quite attractive right now, especially Nvidia. It looks very attractive. Meta looks attractive. Google looks attractive. Apple, not so much. Tesla, not so much. I think Amazon is a really good buy as well. I think the Nasdaq 100, some of these semiconductor names looking really, really good, relatively speaking. I'm also holding out for gold. If gold can get to this 2,700 area, that'll be very, very good. But gold has a lot of tailwinds from central bank buying to tariffs, the administration, everything in between, inflation. So, gold has a lot of tailwinds, and we might not even get to this 2,700 area. But if we do, I'm a very, very big buyer in gold. But all in all, guys, I remain constructively bullish on equities, but we are in a daily downtrend right now. And if we get bad data tomorrow, especially on the inflation front, do expect us to go lower. But a cooler print or an inline print, and we could start to find support, and then we'll make our next move in stocks, the S&P 500 and the Nasdaq 100. So add to names you like, add to ETFs you like at these levels, guys. I think we either find support right here, and with the right data, we can make the next move higher. It just depends on that inflation print as well as the personal income outlays. Diving into sentiment, this is the BofA sentiment survey, and what we've seen right here, guys, is bearish capitulation. This is bearish capitulation in action. 60% of sentiment votes were bearish, only 19.4% were bullish. And this all comes after last week's growth scare, as well as some of the tariff news that we've gotten over the last couple of weeks in the EU, Canada, China, and many people have chosen the side of the bears. Now, I actually had a look at some data points, and I saw that whenever we hit a bearish peak above 60% in the BofA survey, the S&P 500 returned 17.4% with a 92% hit rate. In other words, 92% of the time it was positive 12 months later. So, guys, this is not a reason to get bearish. this is a reason for you to get incrementally more bullish and for you to start deploying capital. I think we are starting to form a bottom. We could see one last capitulation and flush before we go higher into all-time highs in the S&P 500. Let's actually talk about why sentiment has kind of soured. I think one of the reasons is the yield curve. It's back to inverted based on all of the data and tariff concerns. As you can see right here, guys, it was uninverted. Now it's inverted again, but I expect that to change very, very quickly. I think another reason why sentiment has changed significantly has to just do with valuations. They are quite stretched. And when you have a growth scare and valuations very, very high, the market just pretty much looks for a reason to sell, any reason they get to take the gains they've made over the last 2 years, particularly in a bull market. Investors are going to go ahead and take that opportunity to sell, get some cash, deploy some capital, maybe buy some bonds, or just hold it in a 4.5% saver. Because saving rates, high yield savers as well as bonds, are still looking at 4% and above. And I think investors still find that pretty attractive. And when you also have margin levels looking pretty elevated in a bull market, you know, people need to delever. Any type of growth scare is going to scare them out of positions. And that's why you get this churn and unwind that we have had in the market so far. So all of those things together is the reason why we've seen sentiment sour and equities not perform as well as you would expect them to with regards to the bull market that we're in. Nonetheless, there is some positive signs. This is the insider buy and sell ratio. It's officially here at 7 in the buy zone. In other words, corporate insiders are buying more stock than they're selling stock. This is generally bullish and it bodes well for a positive outlook on the market. It also goes to show that corporate insiders think their stock is undervalued. I've been buying a stock lately called Evolution. The ticker is EVVTY. Insiders have been buying the stock relentlessly, and that's because it's significantly undervalued, pays a good yield, buying back a great amount of stock. And I think it's not just Evolution. There is a ton of stocks in the market that while the broader market appears overvalued, under the hood, there's definitely some great deals to be had by great companies. Now, looking at seasonals, this is another tailwind for the market. Generally speaking, in post-election years in the month of March, we tend to see positivity in terms of returns for the Dow Jones, S&P 500, Russell 1000, and the Russell 2000, but not so much here in the NASDAQ 100. And you can see here that the best performing index is the Russell 2000 along with the Dow Jones and S&P 500. And March seasonals might actually be a continuation. Year to date, in the last, I would say, 7 to 8 weeks, we've seen stuff like the XLK, this is the technology sector right here, and the XLY, the discretionary space. So these are literally the Mag 7 sectors. In this sector right here, you have Apple, Nvidia, Microsoft, AVGO, Oracle. You have all of these tech names. In the XLY, you have Amazon and Tesla. These two sectors are down year to date. Every other sector is up. These are the 11 S&P 500 GICS sectors, and it really goes to show the rotation happening under the hood, and that rotation might actually continue in March because normally we see the NASDAQ 100, which those tech names are listed on, all in the month of March, negative returns, and then the broader market stuff like the Russell 2000 tends to see appreciation of 1.1% or greater. So if the S&P 500 continues to trade flatline or sideways over the next couple of weeks in the month of March, while the smaller mid-cap stocks continue to move higher, that is to be expected. That is what the seasonals are telling us, at least in a presidential election year. But let's actually talk about the macro. And I think the biggest thing weighing on the market right now has to do with tariffs and overall policy uncertainty. And BofA have a very good note here about everything. We're going to go ahead and read it. Recent survey data has disappointed expectations, resulting in growth concerns around downside risk. The consumer sentiment, consumer confidence, and S&P 500 services PMI data for February all came in below expectations, leading to a pullback in stocks and an uptick in market pricing of Fed cuts this year. While we agree that heightened uncertainty from policy actions is a risk to our outlook, we are not concerned given the healthy economic fundamentals. The downside surprises in the recent survey data owe, in our view, to increased policy uncertainty and the timing of policy actions. There's little doubt that policy actions enacted to date by the Trump administration have increased uncertainty. Moreover, the policies have generally been more growth negative since they include spending cuts, tariffs, and immigration restrictions. By contrast, in President Trump's first term, tariffs were enacted only after pro-growth tax cuts were implemented and prices. Inflation concerns also appear to be weighing on consumer sentiment. Households and businesses are probably more sensitive to upside inflation risks today than during Trump's first term, given the period of high inflation that we recently exited. Therefore, policies that affect inflation are weighing more on sentiment today than they are in 2018. We think it's too early to get concerned about the soft data slowdown, starting with Doge. The spending cuts only add up to about 0.8% of total federal outlays, and estimates of total federal job cuts are largely consistent with the number of retirees in recent years. Interesting. Additionally, most of the employment reduction will not affect payroll until after the fiscal year ends in September. Watch what consumers do, not what they say. We also think the signal value from consumer surveys is limited, as there has been an ongoing disconnect between sentiment and spending. Sentiment has been weak since the start of the inflation wave, yet consumer spending has been remarkably robust. The upshot is that economic fundamentals and the hard data show little signs of a sharp downturn in activity. And there you have it. What more can I add to that? Long story short, watch what they do, not what they say, and we'll see how everything pans out. It's still too early to make definite assumptions, but the market is obviously going ahead and pricing everything in as best as it can. Now, looking at earnings tomorrow, the only big name here is Fubo. That's about it. That's all I can see. And then looking at data tomorrow, we get the inflation data. This is going to be very, very key, especially as it pertains to the overall economy. Now, core PCE, the consensus estimate is for 0.3%. We also get personal income outlays. So we're looking for a 0.3% month over month figure here for income, and then spending of 0.1%. Now, the trading economic forecasts are slightly more bullish on the overall income outlays as well as PCE. That's very, very interesting. And then we also get the month over month, year over year PCE price index. And the figures there is for 0.3 and 2.5%. We also get the Chicago PMIs and then retail inventories, ex autos, as well as wholesale inventories. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.